Hello everyone, this is Sir Fahad and today we are starting with the first chapter, which is financial management objectives. I hope you all have seen the introduction of the subject, that where I have told you what are the dimension of this subject and where we will be covering what things. So ultimately this is one of the key areas, which is chapter number 1. This will set the pace of the subject, that how the subject will go about and how we can expect in the future time period, that what will be the key areas which will be observing in the depth in the future chapters. So ultimately, starting with the first chapter, the name of the chapter is for financial management objectives. The reason it is said that it is financial management objectives, because we'll be learning what are the objectives first, then we'll be going into the detail of the objectives, that how to achieve those objectives in the chapter. For the simplicity, or in order to make the video shorter so that you people are able to focus well and learn well, so I have written down some of the things on the board so that you could see it easily and you are able to write it down if you want to. Okay, so the first objective of financial management is long-term finance. We always have to raise some finance for the company. Ultimately, a company cannot run without finance, so you have to understand this thing, that if we need to have some finance, so we need to have some sources too. So what are the key sources? So now some of the students might be thinking, sir, if we have the sources, if we have the finances, if we have all the things already there, so what's the purpose of reading learning this chapter or learning this subject at all? The main problem is that we have to see which option is the cheapest option available. Okay, so now obviously you cannot decide which is the cheapest option until unless you get the calculations right, until unless you get the analysis right, that you analyze all the options and in the end you get from all the options you get one right option for the company. So this is one thing which is called long term finance. How do you get the right option? You go for the cost versus benefit analysis. This is called CBA. Maybe you might have learned this in some of the papers of ACCA, but this is called cost benefit analysis. You see the cost. What could be the cost of taking a loan? Obviously, you're raising some finance for the company. So the cost of raising a loan for the company is the interest. If you're taking a loan from someone, so obviously that person will not be taking the full amount. That person would be expecting something extra for their efforts or for their risk. If maybe God forbid you might default on them, so ultimately they give some interest part too, so they give you the interest obligation too. So ultimately when you are returning the amount, so you have to give the interest. So this is a cost for us. Obviously we have to give something extra, so this is a cost. Okay, what's the benefit? If I give you an example over here, I have borrowed 10 lakh dollars from a company or from a bank maybe, or any other person. Okay, let's make it simple. This 10 lakh dollar is utilized to purchase an equipment, and that equipment will be responsible to make goods and services. Okay, after investing 10 lakh dollars, or after taking a loan of 10 lakh dollars, I can purchase some equipments, and from those equipments I can manufacture goods. Okay, so those goods could be manufactured and those goods can earn me, let's suppose this is a hypothetical example, so I'm assuming that those goods are giving me 12 lakh dollars. That means more than the loan amount. So now it seems feasible. Okay, it seems feasible, but the question arises, sir, have we given some interest? Maybe let's write it down, that the interest is 1 lakh dollars. Okay, so still I am earning 11 lakh dollars, which is going into my pockets, and I'm assuming that this is my profit. So 11 lakh dollars of profit after taking 10 lakh dollars of loan, this is something good for the company. So ultimately you have to look for the options. One more thing I want to mention over here is that there are certain options. We have to go with the option which has the lowest cost and the highest profit. That means the highest benefit with the option. Another option of this could be share issue. If we are going with the company, so your question might be like that, this PLC limited company, let's suppose, or PLC company is doing this thing. So you might be thinking about this thing, you might be wondering about this thing, why we are not taking the share option, why we are not issuing share that is free of cost. Okay, that doesn't cost that much if we take a loan. So now the problem with this share issue is that you are issuing some shares when people are purchasing your share. So ultimately what they are doing, they are paying the company. Okay, you go to the stock market, you pay the broker, you purchase the share. The broker, obviously the funds will go on to the company in the end. So if the company is receiving some amount on behalf of the shareholders, so ultimately the shareholders won't be saying this thing, that okay, you keep this amount, we won't demand anything in return. Obviously it's not good in reality, we cannot assume this thing. So those persons or those people who are purchasing shares from us, they will be expecting something from that. Okay, and what's the expectation? That expectation is the dividend part. When we are purchasing shares, so we have to assume this thing that the shareholders will be demanding some dividends. Okay, some might be thinking that maybe there are some shareholders who don't demand dividends. So I'm making it simple just to explain the concept of cost. So in the case of shareholders, we have a cost of dividends. We have to share some profit with the shareholders. So if we don't want to go for this option, so we have to go with we can go for the loan option. I have discussed only two options, when in the practical world you can observe this thing, there are multiple options available, and out of those multiple options we'll choose those options which have the maximum benefit for the company and lowest cost for the company. I hope so far all the things are clear. Let's sum it up. The first point is saying long term finance. You have to decide what's the cost of that particular item or the option we are analyzing for the long term finance, and analyzing the cost, we also have to see the benefit, whether the benefit is the maximum and the cost is the lowest. If there are 4 to 5 options available, we'll go for the option which has the maximum benefit and the lowest cost. Ultimately, the cost couldn't be lowest, but in one way or another way, we'll be observing the profit part too. Okay, so we'll be going with the highest profit. Don't worry about this thing. Questions will not come directly like this. We will go into the detail how to choose the finance options in the future on chapters. We'll go into the detail of how to manage working capital. We'll go into the detail of how to manage risk. The second component of this is managing working capital. So let's see the working capital. If I explain the concept of working capital is the blood of an organization. A human body is always incomplete without blood. Okay, this is very true. If we say that in reality, if you want to say this thing, that if a human body has something which is very important, is the blood. Obviously blood is fluid, and that fluid carries a lot of things, a lot of nutrients, a lot of vitamins in our body, and carry along that's a, what we can say, a commuting thing, that the other fluids are commuting through this blood. So ultimately we can say that thing. But in the organization, if it is a life blood, if the blood of the organization, working capital is the blood of the organization, so we cannot say this thing that it's the blood. In real terms, or in the technical terminology of accountancy or ACC F9, we say that this is the blood of the organization. That means the organization cannot survive without this amount. So now the question comes, what is working capital? Working capital is the current assets minus current liabilities. You have some amount which is left. You have some amount of current assets. Let's suppose if I'm saying you have $4,000 of current assets. Let's write it down together. $4,000 of current asset, and you have $2,000 of current liabilities. So you have $2,000 of amount which is called the working capital. Sir, what to do with this working capital? This $2,000 will be used to pay short-term debts. Sir, what if you are not able to pay the short-term debts? Because obviously the situation could be worsened. Okay, maybe you could have $4,000 of current assets, and you might have $1,000 of current liabilities. This could also be a situation. So in this case, sorry, I have written it down opposite. So I have to write down 1,000 over here, and I have to write down 4,000. So this could also be a situation that your current assets are less and your current liabilities are more. So you are going 3,000 in negative. So this could also be a situation. So what will happen because of this? There will be liquidity crisis. That means the business will not be able to pay its short-term debts, the short-term liability, the short-term obligation. What do I mean by short-term? The word short-term means within 1 year liabilities. Okay, I have to pay something within 1 year, that is the current liabilities. I'll not be able to make up to the current liabilities, and ultimately my business cannot survive for a longer period of time. Okay, I hope that's fair enough. Let's see the concept of current assets. What does current assets include? The number one thing which is very important, if you are a manufacturing business or even if you are a trading business, you have to keep some inventory with yourself. If you're keeping some inventory with yourself, that becomes part of current asset. We have learned this thing in F2 part. Okay, that was the basic of accountancy. So inventory becomes the part of current asset. And if we talk about account receivable, that is the customers who have purchased from us, and we have sold those customers on credit. Why we are selling these things on credit? That's because there is a market norm, there's a culture in the market, that those people, those customers who are coming in the market, they have an assumption that all shopkeepers are giving 1 month credit. And why do they have the assumption? Because they have been purchasing for many years. If they come in the market, let's suppose I deny the customer, I reject the customer, I say that I need cash, I won't allow you to pay on credit. So ultimately what will happen if I don't allow my customers to pay on credit? So the customer might go to my competitor. I lose the customer, I lose the sale. So it will be something harmful for me. So that's why I cannot do that thing. So first thing is inventory, second is account receivable, third is cash at bank. Okay, that also forms part of my current assets, and the last one is cash in hand. Some people will also be talking about other receivables, that's also a part of current assets. Just to make it simple, I'm not mentioning it over here. And if you talk about current liabilities, majority of times you will look for accounts payable or trade payables in your questions. These are the two interchangeable terms which are utilized in the questions. Other than that, you can also have the other payables term in the current liabilities, okay, depending on what sort of company it is. So you could have more or less items. So ultimately you have to keep your liabilities lower, you have to keep your current assets higher. But again, there is also a problem if you keep a lot of current assets idle. So there is a problem with this thing. The company might be losing in real terms, because with the passage of time the inflation is increasing and the company is losing in real term. What does it mean? It means that the purchasing power of money keeps on decreasing with the passage of time. Okay, today's 5 lakh dollars is not worth the same if we talk about 10 years earlier. Okay, if you go back in 10 years time, so this 5 lakh dollars might be more worthy at that time. But today if we see the 5 lakh dollars, that these 5 lakh dollars might not be able to purchase the same number of commodities today it used to purchase 10 years earlier. So this is called losing in real term. Okay, so if we keep the cash idle, so what happens? We keep on losing things. So again, there are some pros and cons, some problems with the working capital. Working capital should be higher of the company, should be good enough. But the problem is that if it is kept idle, then ultimately you're losing in real terms. So how to deal with the working capital part, we'll see in the later on chapters. I hope you have built some base of this second point. First was long-term finance, from where to finance our company with the maximum benefit. Okay, second is how to manage the working capital in a company. The third one is risk. Ultimately we all do not want to take risk. Okay, this is the reason and why I'm saying this thing, because you have taken this course just to minimize the risk part. Okay, just to minimize the risk parts. What could be the risk? The risk is the interest rate risk, and another risk could be the exchange rate risk. What is the problem with both of these things? See, if a company is importing something from outside, let's take a different example of the Trump tariff part. Trump tariff was introduced, import tariffs, and steel and aluminum was imported from China, if I'm not wrong, correct? So I'm just assuming this is the correct information. So that was imported. So because of the tariffs, because of the taxes on that, ultimately what will happen? Things will become expensive. The raw material will become expensive, and in the end, the company's cost of production will increase and the selling price would be increasing too. But the problem here in this risk is that the interest rates might go up and the exchange rates might go in the negative chance, or in such a way that it affects you in a negative manner. Let's suppose if you are purchasing raw materials from a country at $10 per kg. Okay, $10 per kg. You used to purchase this earlier, but now what is happening? Now the exchange rate has increased, so ultimately the same 10 kgs is, first it used to cost $10 per kg, now per kg is costing you $20. So what is happening? Your raw material has increased in terms of cost, so your cost of production has increased. Increase in cost of production will lead to decrease in profit of the company. So this is one of the problems. Obviously you cannot pass on this cost to the customer, depending on the number of competitors. If you are the only one in the market, you can do that, but majority of time it's not the only one you in the market. There are multiple competitors in the market, so you cannot do this thing. So you have to make sure that your exchange rate risk is minimized. Obviously you cannot eliminate the risk. If I give an example, that if you're crossing a road, you cannot minimize, you cannot eliminate the risk. You can minimize the risk, you cannot eliminate the risk. The reason is that because you can see on the right hand side, you see on the left hand side, make sure that no car or any vehicle is approaching you when you cross the road. Okay, but the problem is that this cannot be eliminated. Maybe God forbid, if you're crossing the road and all of a sudden there is a car which appears in front of you and it hits you badly, so ultimately it was not your fault, but it was the risk which cannot be eliminated at all. So ultimately this exchange rate risk cannot be eliminated. It can be reduced up to a certain minimum level. Next is interest rate risk. What is the risk in interest rate? The interest rate risk is that the interest rate of the company might be increasing. If the interest rate is increasing, so ultimately whatever you have borrowed for your company, you have to pay more interest on that. And if you're paying more interest on that, so what will happen? You are losing in real terms. Okay, you are losing in real terms. What does it mean? It means you might be purchasing something at a lower cost. Earlier in investment, you bought some loan, you took some loan at 10 lakh dollars and you are paying 20% interest on that. Now you have to pay 25% interest on the same loan. So ultimately your profits will be shrink down. So because of shrinking profits, this is also called a risk. And these all three factors will be catered in different chapters in detail. Okay. F9 is made in such a way so beautifully that every other concept, every other heading which we are discussing today will be dealt within in every other topic in such a detail that you will be able to cover up all these three things. Okay. If anyone asks you on any fine day that what does financial management teaches you in ACCA, you can tell about these three things. That is management of long-term capital, management of working capital, and management of management risk of the company. That could be interest rate or that could be the exchange rate. Now, third question which comes in my mind, some students might be thinking, sir, is it possible that the company might not be involved either in interest rate or exchange rate? Maybe they have invested their own money and they don't have anything with the outside countries in the abroad or anything. Their raw materials also prepared locally. Obviously, that is also possible, but the problem remains the same. Exchange rates do affect you directly or indirectly. You have to look for the ways in which the risk could be minimized. How it could affect you indirectly? You can see that the fuel prices keep on changing. The Iran and Israel war, which is going on, and now there is a ceasefire, obviously, but it was going on earlier. So the commodities were expected to rise in terms of price. So this is one of the problems. You could be hit indirectly in your business. So you have to make sure you minimize the risk in such a way that it does not affect you negatively at all. Okay. So this was one of the overview of chapter number 1, and I hope I made sure that I taught you in detail. If there are further questions, you could ask me, and we'll be just summing it up and we'll be just ending this chapter. So we'll meet you again in the next video, that is chapter number 2, and we'll go into the further detail of F9 financial management. Okay, thank you for watching. Goodbye.